Construction has topped UK insolvency tables for 4 consecutive years. This is not a coincidence, it is not a one-off, it's not a tough quarter. This is structural stress against the construction industry. Now if we go back to 2025, there were nearly 4,000 construction companies that became insolvent. That is 17% of the whole of all the UK insolvencies last year. So 1 in every 6 failures. Let that sink in. If you are in construction, you are statistically in the highest risk sector in the whole country. And here's the important bit. Construction directors aren't bad people. They're not cowboys. A lot of the time it's about fragile margins. People go into site at -5%, I've heard. There's a lot of capital needed, high capital intensity. The cash flow is delayed. The cost to borrow money is going through the roof. You've got supply chain dependency. And construction businesses don't collapse loudly. It's very slow, very quietly, and then suddenly. Now, why is the construction sector exposed? I want to try and break this down properly in this video. Now, construction structurally is different to most sectors. Number one, the cash flow timing is absolutely brutal. You have got to pay wages weekly. You pay materials at 30 days, sometimes up front. You've got to pay your subbies fast, but you're waiting 30 to 90 days to get paid, and often longer. Now, imagine one customer delaying their invoice to you. It's not just inconvenience, it creates pressure paying your VAT, pressure paying the PAYE, pressure paying all the suppliers. You go into the overdraft thinking it'll get better next month. Now, construction companies, they don't fail because just revenue falls off a cliff. In my experience, they fail because cash arrives late. It happens all the time. You know, let's move on to margins. Like margins are, I'm seeing margins being razor thin at the moment. Now, a lot of construction firms are operating on margins between 3 and 8%. I mean, one error, one pricing error is going to wipe profit out of a job. One material spike wipes profit. You know, a labour issue puts you in the red. A dispute can kill a business stone dead. It's not necessarily guys are mismanaging the construction firms, but they've just priced something wrong. Or what's really common is one company decides not to pay them, you know, subby bashing. I think we need to talk about financing. You know, point 3, financing costs have changed the game the last few years. It's critical. Construction firms rely heavily on overdrafts. They rely heavily on asset finance. They rely heavily on invoice discounting. And when interest rates rose, the cost of finance surged. And projects that may have made sense at 2% borrowing, they don't make sense at 6%. And add to this, the options to refinance have narrowed. So businesses that could previously roll facilities forward, they couldn't. And that's what people mean by legacy high financing costs. It means old decisions that were made on a different landscape are now very expensive, and they're making a lot of firms unviable. If you're in construction, you understand this. Number 4, delayed projects. They are destroying people's forecasts, because construction companies, a lot of their business model is forward planning. You know, we're on this job, we're going to get onto that job, we're at contract stage here. And when a major project is delayed or paused or cancelled, that overhead to run the business doesn't disappear. The staff still need paying. The plant is still leased. The yard is still rented. The vans need financing. I spoke to a guy the other day. Like overnight, 3/4 of his business, his revenue is gone. He's still got 40 vans outside that need paying every month. And when this happens, when the projects get delayed and the revenue doesn't land, what starts to happen is the director will go, right, this is going to get better. I've been through this in the past. That 50 grand I've got there for the next VAT bill, I'm going to need to use it for working capital. This is when like PAYE slips, and that's when the trap stops forming. And listen, you're not meant to do that, but I really understand where people are coming from. They think things will get better. Their staff need paying on Friday, their supplier needs paying next week or they're on stop, and they've got 50 grand in a VAT account. Now listen, if I've said anything, by the way, that's caused you to worry, concern, and you're a construction business, or you're any business and it resonates to you, go in the comment section, the top of the description, there is a link. Click on that link. One of my team will call you today, okay? In addition to that, if you want an absolutely free guide on insolvency, click in the description and we will send you a free guide, okay? I want to talk about the supply chain problems, because remember, in construction, you don't operate alone. If one subcontractor fails, you absorb that delay. You absorb the cost. You can absorb the penalty risk. If a major contractor fails, and this is happening all the time, you don't get paid. Retentions are frozen. The cash that you thought you had evaporates. And what happens in construction is an insolvency over here causes a domino effect, and it hits the little people on the way down. And what makes it worse is when these big firms collapse. Back in 2025, a handful of large contractors failed, okay? And when these large firms collapse, the smaller firms don't feel safer. They feel exposed, because when a £100 million plus contractor fails, suppliers will lose confidence, lenders tighten terms, credit insurance becomes harder, clients delay payments, and across the sector, the confidence drops, and construction runs on confidence as much as it runs on cash. Now, directors make a lot of mistakes here. And this is the pattern that I see repeatedly. I've done this for years and years. I've supported lots and lots of construction companies through insolvency. And it rarely starts dramatically. It starts with one contract underperforming. Then a VAT payment is delayed just this once because we're going to sort it out again next month. PAYE is juggled. The directors continuing to take drawings through dividends even though the company's not making the profits that it once was. And that director's loan account creeps up. Suppliers will start shortening terms. That overdraft is maxed out permanently. And what was a 20 grand overdraft is now, with no PG, is now at 50 grand. But there's a personal guarantee. Then the director will scramble and go, right, I need to sort the HMRC out. I'll set up a time to pay arrangement. But they're setting a time to pay arrangement with HMRC that I believe was destined to fail. They really needed to ask over 3 years. And because the enforcement agent's in their business premises, they've agreed to do it over 9 months. And the time to pay arrangement collapses. And all HMRC is seeing is repeated non-compliance, failed time to pays, increased exposure. And that's when the escalation starts. It's like no single step feels, like it dooms you. Don't feel catastrophic. But together, they're removing every safety net that this director has. And why I think construction directors feel it personally, more than most sectors. I touched on it earlier. Construction sector directors often sign personal guarantees. That'll be on plant, it'll be on vehicles, it'll be on the factoring company. They'll personally guarantee the overdraft, personally guarantee the leases on the building. I think most of them end up with directors' loan accounts that are overdrawn. And when the company becomes insolvent, these exposures don't vanish. They crystallise. And it's not just the company that's in trouble, it's the director now that's got personal guarantees that are going to hit him personally if the company fails. And then you've got the false hope moment. There's always a moment in struggling construction firms where the director will say, I've heard him say it to me countless times, we're busy, we just need one good month. And that is a very, very dangerous belief, because busyness does not equal profitability. You might be busy fools and your jobs are losing money and you're just digging that hole deeper. Revenue does not equal liquidity. The firms that survive are not the busiest, they're the ones that actually put a stop in and go, act early, right? Where are we at here? Are you doing a profit and loss for each individual job? They control the exposure and they stop digging. They don't sign PGs just to pay wages on Friday. They don't agree to time to pay arrangements with HMRC that are unrealistic. Now, if you're a construction sector boss, in fact, some of these tips are very general and they'll help any company. But what you should be doing right now is stress test the business, If one major contract disappeared tomorrow, what happens? If this person doesn't pay, what happens? If I lose 30% of my revenue, what happens? Number 2, review personal guarantees. Know exactly what you've signed, what suppliers have asked for a PG, what loans, what credit cards. Is the premises backed by a PG? Please check your director's loan account, especially if you're starting to have some difficulty. Look at your balance sheet. Look at your balance sheet at least once a month. Where is that director's loan account sitting? And if your business is starting to make less profits or it's becoming insolvent, you need to change how you're paying yourself. You need to stop taking dividends, because those dividends, if you become you go into insolvency, they're going to be classed as unlawful dividends. They're going to be put on a director's loan account that you're going to be personally liable. You've got to stop using HMRC as a bank, because what used to happen over 12 months happens in 4 or 5 now. Their escalation is so much quicker in 2026. You've got to act before enforcement, because early action, it preserves options. Now, construction leading insolvency table, construction sector leading the insolvency tables for 4 years isn't bad luck. It is a warning. The whole sector is on a knife edge, and if you're feeling pressure, you're not alone. But the mistake is believing it will correct itself. The directors who protect themselves are the ones who move early. If you are a UK construction director under pressure, speak to us at director first before things compound. We'll assess your exposure. We'll explain the real risks that you've got going on, not just for the company, but for you personally. And we'll help you decide what the safest paths are forward. We'll go through the insolvency options, but also the non-insolvency options. And it could be restructuring, or it could be actually using an insolvency option like liquidation or administration for protection. But there's always a solution, but it's only if you act early enough. A lot of construction companies are looking at pre-pack administration as a way of saving the business. Now, what I want you to do, in fact, go to this video over here, and we're going to talk you through everything there is to know around pre-pack administration, how it works, what the steps are, and whether it's possible and suitable for your business. Thanks for your time, Chris Worden.